Welcome, everyone. This is Lowell Pratt. Thank you for joining us this afternoon. This is our first of what will be many, many quarterly updates. We want to, on a regular basis, cover the big events that are impacting the economy and the stock market and the other markets that we invest in. Our ambition is to keep these briefings to 30 minutes in length. For the presentation part, it will be followed by Q&A. Any questions that we can't cover during that Q&A, we'll cover one-on-one afterwards. Again, the ambition of this is to make sure that clients are as informed as they can be. It's my privilege to be able to do this with what I'll call our young guns in the company, kind of our third generation of the Bernie company, if you will. 32 years ago when I came here, there was a generation composed of Jack Burney and Ted Rosenberg and kind of the first crew that launched the company. Myself, Russ, Yev, others kind of formed a second generation. Bijal, Andy, and Adam are key players in what will be the third generation of the Bernie company. So Bijal Patel, I've known for 25 years professionally. He's been with the Bernie company for the past 6+ years. Many of you have had an opportunity to interact with him. Adam Newman is newer to us. He's been here about 16 months, but he has 10 years in the business. And as you'll notice from the slide, he's our solo dual CFA, CFP, very sharp and on the ball young man. And then Andy Pratt, again, many of you probably have had a chance to interact with him. He's been full-time with the company for 6 years. He's interned 4 years prior to that, so that makes it about 10 years total. And of course, I probably have known him for all of his 28 years. So I'll pass this over to Bijal, who will take care of some housekeeping, and then we'll go through the deck. And again, as you come up with questions, please shoot them towards us.
Thank you, Lowell. So a few housekeeping items before we start today's presentation. As mentioned, you'll have the ability to submit Q&A. You can do so by clicking on the icon on the top left-hand corner of your screen. Any questions we don't get to by the end of today's presentation, we will address with you on a one-on-one basis. So in terms of today's presentation, what we will do is we've broken down the material itself into a couple different segments. What we would like to do is give you an update on the overall economy, both here in the U.S. and internationally. We'll also talk a little bit about just different effects that headlines are having in the overall market itself. And then the second half of the presentation will be very specific to the investment strategies that the Bernie company currently uses when we manage our U.S. equity portfolios. So you have the opportunity to hear from all three of us in different topics that will be presented. So to start with, what I will do is I will hand it off to Adam Newman, who is going to give us a brief market overview.
Thanks, Bijal. As a way to kick things off, what I want to do is provide some global context across various asset classes. So although our history and our expertise has been in navigating the U.S. equity markets, we understand that most of our clients and investors have exposure to various other types of assets. And so what you see here on this opening screen is really a summary and a dashboard of broken out by stock and bond categories of just really performance through the first half of the year. And so we know over any 6-month period this will vary, but I think what's happened so far behind the economic backdrop has provided investors with a different experience depending on where their exposure is. So the big story for first half of 2018, I think, is the continued resiliency of the U.S. stock market, and really even outside of just the 6-month period, we're at a point where the S&P 500 is on track for its 10th annual consecutive gain, which, by the way, in its history, believe it or not, it's never happened. We've come close, but no cigar. We've had 8- and 9-year stretches, but never in its history has the S&P gone on such a run. So that's been a positive, and it's also just caused some questions for investors, which I think we'll address during the call today. So positive here in the U.S. in terms of returns so far. You look overseas, the story's a little bit different. So we break this out by international developed and emerging markets. When you think of international developed markets, you think of the more established global economies like Australia, Japan, most of Europe, Canada. And then when you think of emerging markets, you think of the standard emerging economies, the big four being Brazil, Russia, India, and China. But both of those markets have been in the red for the first half of the year, with emerging markets being hit a little bit harder. A lot of this has to do with currency. So the dollar is strengthened, which has hurt domestic investors that have money overseas, and also the talk around, the trade. They call it the trade war. We don't internally particularly like that term, but they call it the trade war, and the volatility that's really caused for international investors. Rounding out global real estate, so real estate investment trust investors have enjoyed a strong first half of the year despite rising interest rates. And with the bond market, it's been fairly flat. So a lot of talk in the financial press and amongst investors about interest rates going up. This is a theme that's been going on for a few years, but we'll talk about interest rates in a little more detail in a bit. But rates have gone up, and the bond market has been fairly resilient behind that. More important than just looking at the 6-month period, down below we've got some statistics for each of these asset classes to give you an understanding of the risk and return characteristics. So we've got the average quarterly return. We've got the best and the worst quarter for each of these different categories to give you really some flavor around not only what the averages have been, but what the best and the worst case scenarios have looked like. So really meant to be educational in nature and provide some context around what's happened by broad asset class. Now, if we go into the different sub-layers of the investment universe, we call these sub-asset classes. Within these different domestic and international indices, you have more specific targeted segments of the market. And I'm not going to spend a whole lot of time here, and we're happy to provide this as follow-up, but this gives you an understanding between domestically and internationally, large cap, small cap, value versus growth, where the strong returns have been and where the weaker returns have been. So this really, I think, continues just to line up with the theme of, domestic outpacing international and the continued struggle of the emerging markets. And before we jump ahead to some of the economic themes, and this is in tandem with a lot of our clients' questions leading into this presentation around performance, particularly the performance of the S&P 500 index. So we really wanted to provide some context at the sector level and also at the individual company level around what's been happening. So on the left-hand side of this chart, which was produced by Bank of America, which I think is pretty interesting, what you can see is the first half of the year performance by various sectors. And I think the big theme here is that the tech sector continues to be the leader and the strongest performer. And within the technology sector, I'm sure most of us have heard the term the FANG stocks, which is made up of Facebook, Apple, Amazon, Netflix, and Google. Those stocks in particular have accounted for a significant portion of the index's return, which is reflected on the right, where you see just that handful of stocks has contributed an exceptional amount of return relative to the 2.65% year-to-date performance of the index. But if you extrapolate those stocks and just look at all of the other companies that make up the S&P 500, those companies and their returns has actually been slightly negative on the year. So it just goes to show the continued concentration in terms of performance and where that performance is coming from, which is important to consider when you think about our long-term posture of maintaining balance and diversification across sectors. So if you're taking very concentrated and isolated bets, you've been rewarded, but there's the risk that's associated with that, and that's something we like to keep in mind for clients. And I think on a last note here, what's been disappointing this year, interesting, let's say, is the continued lagging performance of some of the sectors that should be benefiting from a stronger and a strengthening economy. You think of materials, industrials, the financials. These are all sectors that as the economy has improved and done well, we not quite yet have seen them turn around and reward investors the way that you might expect. And so as we move into the economy and at the broad level, what's happening and what's contributed to continued strength in the markets, I want to have this slide here as a backdrop to those comments. And this is really, if you see here, you've got the chart that's showing the world stock market performance through the first half of the year, but more importantly, layered on top of that, some of the big headlines that we've seen. So any given day when you tune into the markets, there's some headline indicator or some headline commentary that's drawing people's attention. And I just wanted to layer that on top of what's been happening. So there's context to some of these comments. But I want to fragment out the economic commentary into a couple different components here. The big one being the earnings season and what we've seen through the first half of the year in terms of corporate earnings. And I think the best way to track this is just looking, again, the top 500 companies in the U.S. as reflected in the S&P 500. And so far, it's been so good, where these companies have reported about 25% year-over-year earnings growth. And that's coupled with top-line revenue growth of about 8%. So just looking at the numbers in isolation, it continues to be a really healthy earnings environment for companies and their employees. This has been, at least in terms of the 25% year-over-year earnings growth, has been the strongest since the third quarter of 2010. So when you combine the two, I think it's a healthy corporate environment. And what's been driving that is going to be important going forward. So the economy itself has been resilient and continues to strengthen. And we've seen that in the jobs numbers that have been reported so far this year. Through the first 6 months, we've added in the U.S. about 1.2 million jobs. And we still are on a streak where we have not reported a single monthly aggregate job loss since the back half of 2010. So the labor market continues to be fairly resilient and really strong. And this, again, trickles down to the consumer. So if you're employed and you feel good about your employment prospects, you as a consumer typically are going to feel a lot more confident. So if you look at the consumer confidence and the spending numbers, they I think are really reflective of the strong job market. So both the consumer and the labor market look really good, and that's something that needs to be considered as we make investment decisions, as we look at the trajectory of the economy itself. Lastly, I think the other headline through the first 6 months of the year has been revolving around the interest rate environment. So obviously, as we have a stronger economy, that trickles down into interest rates, and you typically, with the strengthening economy, see interest rates start to rise. And what we've seen, especially with short-term rates, as the Fed has been raising rates, you've seen both the 2 and the 5 and even the 10-year Treasury yield rise. So what that means really is, where the conversation goes from there is around inflation. So some of the big questions investors are asking today revolve around will rates continue to rise, and how will that impact the bond market? And also, does this mean that we're on the cusp of an inflationary environment? And so the Federal Reserve today, unlike past cycles and past years, I think they communicate very openly with the investment community. They're very transparent with their forecast and with their their ideas and thoughts around future rate hikes. So that's something that I think we'll be watching, and that the investment community will be watching going forward. But in aggregate, domestically, we're looking at strong consumer, strong earnings and revenue environment, and I think this is a good segue, to the back half and the rest of this conversation on the more granular level about our positioning and how we think this all ties together.
So thank you, Adam. As we transition over for that update, what we'll do is pass it over to Andy. He's going to go over a little bit more detail in regards to specifically how the Bernie company approaches its allocation to the U.S. equities market.
All right, thank you, Vijal, for that introduction. As Vijal mentioned, I will be going over the Bernie Company's U.S. equity strategy, which we call our size and style responsive strategy. And I'll start by kind of explaining what it means to be size and style responsive and what we're aiming to accomplish with this strategy before going into what we're seeing today and where your portfolios are being positioned. So this strategy was born out of research done by Nobel laureate William Sharpe in 1992 that found that the dominant variables in U.S. equity returns were size, how large or small a company is, and style, how if it's considered growth or value. And this research has been, backed up by other academic studies and other types of studies over the years. And generally, what it's found is small cap stocks outperform large cap stocks, while value stocks outperform growth stocks over the long run. So you might ask if, and this might sound counterintuitive at first, growth stocks are often marked by new companies with exciting technologies that are growing earnings at a very fast rate. But the insight here is that price also matters. So while growth stocks have to work extremely hard to justify high price multiples, value stocks, which tend to be downtrodden and temporarily out of favor, benefit not only from growing, but price multiple expansion as their finances stabilize and market overreactions lessen. So the question is, if small and value stocks outperform other types of stocks, why not just invest in a small value portfolio and be done with it? Well, it's true that in the past anyways, while investment returns would have been greater, investor returns would very likely have been worse. And the reason is size and style cycles are marked by their cyclicality. There are long periods of times where large cap stocks will outperform growth stocks and vice versa. Small stocks and vice versa, and growth stocks will outperform value stocks. In fact, the average style cycle has lasted 18 to 30 months, while the average size cycle has lasted 3 to 6 years. And in fact, zooming in to today, over the past 10 years, growth stocks have actually outperformed value stocks by 70%. And in a shorter time frame, really over the last 4 years, we've seen large caps have the advantage as well. So it's very difficult to stick with your strategy if over a 10-year period you're underperforming by 70 percentage points. So that necessitates the flexibility to rotate between size and style. And while our strategy does aim to capture the small value premium that's available in the market, it also acknowledges that you need to be flexible to be able to achieve consistent long-term returns. So what we do is we will rotate your portfolios to the size and style segment of the market that's currently in favor to try to take advantage of returns just no matter where we are in the market cycle. So that brings me to today, with the question is, where are we today? So we're looking at this first chart here. These cycles can be seen in rolling return differentials. So this one is style. So as you move up the chart here, you're in a pro-value phase, and as you move down the chart, you're in a pro-growth phase. So as we've seen here in the rolling 12-month return differentials between growth stocks and value stocks, growth has been pretty steadily in favor over the last few years. In fact, earlier this year, we actually saw a brief value counter trend, but even that momentum seems to have reversed, and growth once again is in favor. So what this means is we've been allocated towards growth stocks. Even though value stocks have that long-term edge, we've been allocated towards growth stocks over the past few years to try to take advantage of this. And one quick note I wanted to point out is this research that was done by Sharpe in 1992 was, that's when it first came out. It was probably fully understood by the market in 2002. And in the 2000s, we've kind of seen an odd phenomenon where value peaks have been less than their historic norm. Will this continue? Who knows? Markets are fairly efficient. So it is entirely possible, while we are not fond of saying this time it's different, in fact, we probably never will. The responsive nature of this strategy allows us to adapt to whatever is happening right now. So, value peaks may not be achieving what they are. So value investors, especially recently, have really struggled. And having that flexibility to switch towards growth and stay with it for longer is beneficial. So moving on to size. Similarly, small caps have outperformed over the long run. And as you move up this chart, you're getting into pro small cap territory. And as you move down the chart, you're moving into pro large cap territory. So we've actually been in a neutral posture for some time. Large caps, if you go back, about 5 years, have enjoyed a relatively modest premium to small caps. And really since August of last year, there wasn't really a strong signal one way or the other. So we've actually been neutral in our allocation to size since August of last year. And what that means, keep in mind, when we say neutral relative to the market as a whole. And of course, large cap stocks being bigger than small cap stocks comprise more of the overall pie than small caps. In percentage terms, large caps represent about 75% of the US equity market, whereas small and mid caps take the remaining 25%. But as you can see, so far this year, we've begun to see some momentum shift back to small cap stocks. If we go one more slide here, we'll highlight that. And, of course, there's always multiple explanations for any, phenomenon that's going on in the market. But one explanation, that's going on right now is, as Adam mentioned earlier in his presentation, U.S. and foreign trade partners have been at odds, slapping tariffs on each other. And while tariffs are a net negative and drags everyone down, large multinational companies are affected more strongly than smaller cap companies that tend to be more domestically focused. So this is at least a partial explanation for why this momentum has started. But once this momentum does start, it tends to persist for some time. So, and again, as we're seeing over there in the style chart, the peaks have been much smaller than they have historically. This chart goes all the way back to 1925. So again, it's possible that as the market digests new research, these peaks and valleys become less extreme, but the momentum still does exist. So if we go on to the next one here, this is the change. So we have a change to announce. Recently, like I said, we have been neutral with regards to size, but just this month, we decided to shift our size allocation towards small caps. So in percentage terms, we've gone from neutral to a 10% allocation towards small cap. And this chart can show you exactly what we're talking about there. So as you see, the gold bars represent where we were, and the blue bars represent where we are now. As you can see, the growth bet remains the same, but our allocation towards small cap stocks have increased. So what you can expect is trading to continue this quarter, maybe a little bit more trading than normal, to redeploy assets out of large cap stocks and towards small cap stocks to take advantage of this expectation of continued small cap outperformance.
Thanks, Andy. For those of you that have heard us talk before, size and style does have a very important impact in overall portfolios. The third letter S that is important to us is SCORE, and that is how we internally rank individual stocks. And what I'd like to do is give Lowell the opportunity to kind of talk about the makeup of SCORE and the importance that it plays.
Thank you, Bijal. And before I get into SCORE, I just want to briefly touch on this chart. This is data that Jeremy Siegel, a very prolific Wharton professor and speaker, shared at a conference I attended a number of years ago that shows major asset class returns. The y-axis is the change in the dollar value on an inflation-adjusted basis. And I just want to make the point that the stock market evidence as a long-term proposition is pretty overwhelmingly positive. We all know the short-term risks that are inherent in stocks, but from a longer-term perspective, not only are stocks the highest returning of these major asset classes, if you advance the clock, it's also the only asset class where you can use a ruler to draw a trend line. And I can make a case based on this that stocks actually in the very long run become the most stable, the most predictable of asset classes. And as you can see here, it's also the best inflation hedge. And so, when the market gets choppy, and it will periodically, of course, through time, it's always important to go back and remember the advantages that stocks have as a long-term proposition. So SCORE is a Berney Company proprietary stock picking modeling process that Jack Berney began back in the 1950s when he retired from the Army in 1974. He started using this in a professional capacity. We've made a number of refinements through the years, but the basic gist of the process remains the same. It's a persistence-based modeling process. We're going to look back historically. In our case, we're going to look back. The primary look back is one complete style cycle, which averages about 4 years in length. And in that, we'll break that into 4 intervals. And in that, we're trying to neutralize the effects of value and growth and find the types of characteristics, company characteristics, that are effective in both of those types of phases. We build 40 to 50 factor models from this work. What typically comes through, and I should also mention, there's a long-term confirmation look back that requires factors that are used in a model to also show the same association with excess return over the longer period of time as well. And what typically comes through are quality companies that have good profitability, reasonable valuations, and mostly we're going to get fundamental influences as opposed to technical influences, which are a result of that relatively long look back, the 1 to 4 years. This would also be known as the equity characteristics associated with a risk-off or risk neutral type period. And that's the market most of the times. When the market has major sell-offs, the riskiest assets will sell off the most strongly. And then following those, there's a risk on sort of market move that's very predictable. Most of those red intervals, and I should explain in the table on the delta column, it's basically the difference in performance between the buys, the highest rated companies, and the sells, the lowest rated companies. And many of those inverted intervals are associated with those market recovery periods. And we actually have a response to this that we'll cover in another session that we describe as recovery score. Sometimes the market will go risk on for other reasons, and we've seen that recently. Where in the last 2 intervals, we've actually, well, primarily 2 intervals ago. These are all 6-month intervals. The market became risk on again. So every once in a while you'll see this. We don't like to have SCORE invert, but it's the nature of the beast, if you will. What's important, though, is to persist with this strategy because, as you can see, over long periods of time, there's a significant amount of excess return that can be captured. So the other thing that's important to understand is that a score at an individual stock level is not predicted to any significant extent. This first chart that we're looking at here is score to performance for an interval in time. And as you can see, one stock at a time, there appears to be no pattern to the data. However, by combining this into 5 and 10, and I think at the end it's a 25 stock combination of companies, you can actually see the effect of SCORE. And there is an opportunity to capture excess return, but that opportunity only exists at the portfolio level. There will always be individual stocks that will be very disappointing to look at in your portfolios. There will be other stocks that will be great stocks. It's very normal to have a mix of both of those in the process of building these portfolios.
Yeah, thanks, Lowell. One of the things that happens that we see quite often with the market itself, and this is part of the overall philosophy here at the Berney Company, is that our approach is to say that we are not market timers. Our approach is to say that we believe to be 100% invested 100% of the time. The question is, where are you invested? Do you have size, style, sector, and score into consideration in terms of where you're invested. That will help smooth or at least reduce the appetite to react to short-term market news events, which could create, the urge to getting out of the market. I think many times we've seen this before in regards to the impact of market timing and missing some of the best days in the market itself. Just taking your money, investing it, looking back to 1990 to current, and just in the government T-bills, you get a return of about 2.77%. And then staying completely invested and not reacting to short-term noise, the S&P 500 has produced a return of 9.8%. And you can see by the graph, just in terms of missing the one best day all the way down to 25 best days in the market over that time frame, what a significant impact it has on one's overall returns. And this is one of the main reasons as to why here at the Bernie Company, our team takes the approach of being invested all the time, but the question is, are we invested in the right areas? And therefore, collectively as a team, we're always having a conversation around size, style, sector, and score allocation. In terms of looking forward, since we're at the midway point of the year itself, things that we should be looking at in terms of the second half of the year that can be helpful to you to making sure that you're on track to being a successful investor, I would say, is take the time to review a budget. The summertime becomes a great time for those with families to go on vacations. I use an analogy of taking a road trip. These days, I don't use an atlas map when I get in the car, but I do use Google Maps or Siri to tell me where I need to go. Waze is another app that my son will tell me that I need to take a look at. And what ends up happening is halfway through the trip, it's going to give me an alternative route, right? It's going to tell me that there's a way that I can get to my destination either faster or by avoiding some traffic. So same thing I would say, the way that you view your budget itself. If you started off the year in terms of like what your goals were, evaluate where you are today and what adjustments can you make in the second half to achieve those. As part of that, with the idea of budgeting and where you're savings, I think this is a very important part of one's success in terms of being a long-term investor is not only your investment return, but on an annual basis, where are you saving and how much you're saving. So this becomes a great time to evaluate if you do have excess cash flow, if you're saving within retirement accounts or taxable accounts, are you filling the right buckets accordingly? This is something that we can help you with. A big one that we saw this year, especially with the tax reform earlier this year, that it's a great time to evaluate where you currently stand in terms of taxes themselves. Are there any big impacts because of the tax laws that are going to impact you? And now's the time to take action. You have still the next 5 months to make adjustments so that there's not a big tax surprise next tax filing season. I get this one quite a bit in regards to, especially just where the market is today and for those that are sitting in cash. And I ask the question, it is always important to have a cash reserve for every family. The question is, how much should I have? There's a rule of thumb out there that would say 3 months is a good starting point, but I think that it is customized to each particular family. This is something we can help you with. But if you look at that as a starting point, you can tell yourself, do I have too much or too little? And then from there, start having the conversation around how to properly allocate your overall allocation itself. And with all of those things being said, I'd say this is a good time that between looking at our team here at the Bernie Company, sitting down and having a conversation of understanding where you have been so far this year and what can we help you with moving forward when it comes to overall personal finance. If you have questions that are kind of outstanding, please do reach out to us individually and we can set up an appointment and help you. So that concludes kind of the prepared remarks that we have today. Before we get into Q&A itself, there were some questions that were presented to us earlier. And the first one I would say, and I'll throw out to the team itself, is we've been getting questions around just the length of the bull market. I think Adam had made mention too that we're coming upon perhaps the first time in history that we're going to see a 10-year bull market. So the question is, what are our thoughts and what are we doing about this moving forward?
Yeah, we actually have a few questions around this, so I'll spend a little bit of time there. But before we do that, there's also a comment around the availability of the slides and the audio recording. So I just want to make it known to the audience that both the slides themselves and the actual recording will be available afterwards. So stay tuned. We'll give details around where you can access that. But I think we're on right now about the let's call it the 111th or 112th month of this rally in U.S. equities, which by historical measure is the second longest in aggregate. And I don't think it's unlikely to say that sooner rather than later we might get over the hurdle for this being the longest rally that we've had. And obviously, when you look at just the pure fundamental valuation ratios and compare that to historical averages, it has many, especially in the media and in the headlines, continuing to say that markets are overvalued, that we're at a peak. And I think you can go back even several years and find pretty extensive commentary on that being the case. But what we like to do is not compare today to where we've been historically, but to be a little bit more forward looking. And I think the reason why we need to evaluate this question in the context of the future is because we came out of the financial crisis, and that was a period unlike anything we've seen before. And in reaction to that, both the government and the Fed had to enact policies that were historically, never done before, and that might be bleeding into some of these numbers, especially the economic figures, the yield curve, and impact the markets in ways that we might not have seen in the past. So if we look ahead, if you look at the price of the, let's call it, just continue to use the S&P 500 as our proxy, but if you look at what companies are earning today, and if you look at what they're projected and saying that they will earn in the near future, and you take more of a forward-looking posture of the S&P 500, I think when you factor that in, you've got a market that's pretty fairly valued, and a lot of that's driven by the optimism of these companies and their revenue growth and the consumer being strong. So we're getting a lot of positive feedback from corporate leadership around their future prospects. And if you factor all of that in and how they're quantifying this, and then you look at the stock prices relative to those future earnings expectations, I think you get something that looks a little bit better. The other part of this is, and I think there's two components to the yield environment and the inflation environment, but investors always make trade-offs when they're determining where to allocate each additional dollar of their resources. And at the basic level, you've got an option to keep your money in cash or something very safe, or you invest it and you take risk. And with the interest rate environment where it is, you've got 2, 5, and 10-year treasuries yielding well below 3%, and you've got an earnings yield on the S&P 500 that's still hovering around 4%. All things considered, it's still a fairly attractive proposition for people to have, a very meaningful exposure to equities versus the alternative, which is losing money in cash on a real basis or investing in bonds yielding nothing. So it doesn't mean that bonds or cash don't play a role in your overall financial picture. It just means that the way that you allocate those resources needs to be approached differently. And I think if you look ahead, a lot of the fear mongering being done in the headlines is unwarranted when you look at the health of the economy and especially the interest rate environment. So I'm going a little bit longer here before I go to another question, but just to round it out, what I will say is, when you look at sector diversification, you look at individual company diversification, I think what can change, and there's no way to specifically time this, but these handful of companies that are driving the market, I think at some point will just in a healthy fashion run into mean reversion, whereas I think that will put other sectors and other companies in a position to prosper, and if you stay disciplined and remain allocated, to be rewarded for that patience rather than try and jump on a bandwagon of a handful of stocks when you're trying to time out where are we in the game with those returns lasting and being significant.
Thanks, Adam. Another theme that we've seen in some questions that were submitted is that around volatility in the market, and then also the geopolitical risk of investing in news items that we've been seeing so far. So the question is, what are our thoughts and how are we reacting to volatility and also geopolitical events?
Yeah, so I think if you look at the context of volatility, there's different ways that we like to measure this. One of the ways is looking at peak to trough movements in the market, and another thing is through looking at the VIX, which is an indicator of volatility. I think it's without getting into data, and even if you're someone who's just monitoring the markets at the highest level on a month-to-month or day-to-day basis, I don't think it's out of the question or a surprise to anyone to say that so far in 2018, we've seen an uptick in volatility. And although, it's almost like the analogy of, if you're on a smooth plane ride, that's 6 hours in length, and the first 5 hours are perfect, and the last hour you hit some turbulence. No matter the magnitude of that, it's got to feel significant to you because you're used to this smooth and this uneventful experience. And I think that's been the case leading into the first half of 2018 is we've had periods of almost no volatility, and then you get a couple of days and a couple of weeks of movement in a downward direction, and it's caused some knee-jerk reactions. But if you take a broader view and look at things at the highest level, the volatility environment today is still historically, and I think significantly less than what we've seen in the past. You can argue that in different directions being good or bad, and there's no way to really nail down what that means for the future. But I would say, and we talk about this internally all the time as a company, political views aside, we've had a very significantly different president in office, whether it's the tweeting, whether it's the ability to not be afraid to say anything that's on your mind. And this has all happened, and the markets have been really resilient through this. So, trade wars and tariffs have all gotten, a lot of attention recently. But, in spite of the surprise, win by Trump, going back almost 2 years now, and despite a lot of what's been just put out there verbally, and forget about whether or not we've taken action on something, but what's been put out there verbally, and you compare that to what we've seen in the past, it's been significantly different, and the markets have still really held up strongly. So I think the resilience of the markets through these different times, in tandem with just lower volatility, I think in a broader context, it's been fairly smooth sailing on all fronts.
Thanks, Adam. Earlier in the presentation, we had made mention to the FANG stocks and the impact that it's had on performance. Question that we have is that how do we feel about those stocks, and do we treat them all the same or differently?
Yeah, that's a great question, Bijal. I'll go ahead and handle this one here. So as we mentioned in that slide earlier, FANG stocks aren't the whole market. In fact, if you look at the S&P 500, which is approximately 500 companies, 13% of that index is comprised of just the FANG stocks themselves. So they're really what's been driving returns in the S&P 500. That slide showed that if you remove them, the returns from that index would actually be negative on the year. So what happens is it's so easy to compare performance, in any of these indexes. These indexes, that a key point here is that they are market weighted. So the larger cap companies have more of an influence on the performance of their overall index itself. So if you're looking at FANG stocks, some of them actually are investable, and we do have an allocation to some of them. Others, their valuations are probably a bit too rich for our liking, so we avoid them. The key thing to realize, though, and as Adam touched on in his previous answer, is FANG isn't going to be what's in favor forever. And as we've seen here recently with Netflix specifically, none of these companies are bulletproof. So whether concerns from regulators come in, or just the fact that these companies are getting so big, or whatever it may be, privacy concerns with some of these companies, I think eventually we'll see these stocks, go back and revert back to the mean when it comes to performance, and there will be other opportunities for performance. It's something we're seeing, whenever I address a performance question. It's one thing to look back at the past and kind of explain what's been going on recently, but I think it's another thing where you need to look forward as to what can we expect moving forward. And as we've seen small caps gain momentum here, I think we're going to have an opportunity to take advantage of that small cap momentum, and maybe we can get, in terms of talking about performance of all equities, maybe we can get away from FANG and start talking about some other things.
Great. Thanks, Andy. Another question we've got in regards to kind of moving forward is around tariffs and what impact that could have on investor portfolios.
Yeah, do you mind going back in that slideshow there? So we actually, we were running a little bit short on time, so we skipped this slide in the presentation, but I did want to touch on it. So there's been a lot in the news about tariffs recently. You know, some people have called it a trade war. We certainly would not go that far as to call it a trade war. But what we wanted to show here is a chart from Oppenheimer Funds in their 2018 mid-year outlook that showed what the expected impact of tariffs is in relation to the expected impact of fiscal stimulus, specifically around the tax cuts that were passed earlier. So as you can see here, while you know the 200 billion number sounds like a big number, the expected impact on our nation's gross domestic product is only expected to be somewhere about 0.4% of overall GDP. While the fiscal stimulus, obviously the expectation here is for the impact to be much stronger, more like 1.4% of GDP. So, you know, I think that this is important context to keep in mind. We're in an economic situation where this very long recovery has been going on since the financial crisis. We've been in economic expansion mode for quite some time, and it's been a healthy economic expansion. So in that context, the economy growing and the fiscal stimulus coming from the tax cuts, the U.S. economy is in good position to absorb the negative impacts that come from tariffs.
Thanks, Andy. That concludes the questions we've had for today's presentation and the material that we want to present to you. As Lowell had mentioned, this will be the first of many quarterly reviews that we will be hosting moving forward. So I want to thank everyone for their time this afternoon. If you have any feedback or questions, you can contact Kyle McFarland on our team directly, and I will put his contact information on the screen here. Again, thank you for your time.